So now we'll proceed to the next session, focusing on the changes in personal taxation. Joining us, we have Tarun Garg as subject matter expert. So Tarun brings over 13 years of extensive experience in compliance and advisory work, including assigning taxation, representation before income tax authorities, appellate authorities, TDS authorities, and provident fund authorities. So he specializes in expatriate taxation, social security matters, managing diverse portfolio of clients, including both multinational and Indian corporations with globally mobile workforce. Greeting, Tarun. It's a pleasure to have you here.
Thank you so much, Ridhima, and I look forward for an interesting conversation. And I hope I'm able to kind of answer some of the questions that the team and the joiners have. Yeah.
Yeah, so personal taxation is everyone's favorite topic, so I can see a lot of questions coming. All yours now.
Thank you so much. So let me just try and present my screen.
Yeah.
Just let me know, please, once the screen is visible.
Sure. It is. You can share it on the slide share mode.
Yeah. I hope it is visible now.
The slide share isn't. Just one moment. Mhm.
Is it
Please.
visible now?
No. We have the PPT on the screen, but the slides, the slideshow, the show mode is not there.
Has it come now? Still no?
Better. Yeah. That perfect.
Okay. So good morning, everyone. And Ridhima has already kind of introduced me. So now and then in the interest of time, let me just quickly take you through the personal taxation provisions that have kind of come up in the budget. We will start with the individual tax rates and deductions, and then we'll go to some of the income tax scenarios. Here, I'll present a few examples to kind of explain to the audience that how the tax sort of savings will arise, what is there in the old tax regime, and what is there in the current or the new tax regime. Then certain provisions relating to the TDS, TCS matters for the employers, while my co-panelist has already kind of explained, but we'll have some deep dive into it. Then other certain key announcements which are relevant for the personal from a personal tax perspective. We'll also look some bit of analysis on the capital gains, what are the holding period, how it has been rationalized, and then a few interesting aspects on the employment linked incentive schemes and the internship scheme that the budget has kind of focused. So let's just move towards the individual kind of tax rates. Okay. So, what the budget has done is, so anyone who is opting for the new tax regime only is basically getting benefited. So there are no specific changes in the old tax regime. So old tax regime, the rates therein remains the same. But what the budget has done is certain changes are there in the new tax regime. So what we are seeing is that the base threshold is basically remaining the same. It is up to 3 lakh, there is no tax. Now, what the finance minister has done is in the next slab of 3 to 6 lakh, which is kind of there as of now, she has increased 1 lakh therein. So now up to from an income of 3 lakh to 7 lakh, there is a tax rate of 5% which is applicable. So clearly there is a tax saving of 5,000 rupees in this. Now, when we see for financial year 23-24, the next slab starts from 6 lakh to 9 lakh. So how it has been changed again is from 7 lakh to 10 lakh. So there is again 1 lakh addition to that. So that has again will attract a 10% tax rate. So which clearly means on 1 lakh 5% benefit, which is 5,000 rupees, which is coming from here. Then the remaining broadly the slabs are same. So earlier it was 9 lakh to 12 lakh, which was 15%. So currently for financial year 24-25, it will be from an income level of 10 lakh to 12 lakh, the tax rate of 15% will be applicable. Then the rest of the slabs are exactly the same as the current slab structure, which is 12 lakh to 15 lakh of an income will attract 20%, and the above income of 15 lakh will continue to attract a 30% tax. Now, what additional change that has kind of done in the new tax regime is the standard deduction. So currently, when we see financial year 23-24, there were slew of changes that had been made in the new tax regime. Introduction of standard deduction had happened in 23-24. Then the surcharge rate for high income group people was kind of drastically reduced from 37% to 25%. So that those changes had already been made. Now, with that intent in mind and to further promote the new tax regime, a standard deduction has been further enhanced from 50,000 to 75,000. What we also see is that for any taxpayer who is kind of having a family pension income, there is a slight enhancement in the family pension deduction from 15,000 to 25,000. So what it overall means, the enhancements of standard deduction results in another tax benefit of say 20 say of 7,500. So how does it is basically arriving on a enhancement of 25,000. If we apply a 30% rate, it comes out to be 7,500. So in net 10,000 plus 7,500 is 17,500 is the overall tax benefit that will go in the pocket of a salaried individual. Now, if we add a cess to it, education cess, it comes down to 18,200. Now, I would also like to basically add one more thing, the change that has happened in the new personal tax regime, which is enhancement of the employer's contribution towards the new pension scheme from 10% to 14%. Now, that benefit basically comes to the individual taxpayers under Section 80 CCD, subsection 2. So the corresponding changes also happened under Section 36, subsection 1, clause 4A. So which means that the employers who are kind of contributing this 14% of basic salary as contribution for national pension scheme for an employee, there also they'll be eligible for a deduction. Now, what it overall means is that uh, definitely from a tax standpoint, additional tax savings in the hands of the individual. Now, one thing that I would just like to call that out is, look, the overall intent of the government has been that people kind of chooses or shifts towards the new tax regime. Now, the current data that the government was sharing in the budget was that almost two-thirds, which is 66.66%, people have already migrated from the old tax regime to a new tax regime. So again, only changes has kind of come into the new tax regime. Now, moving forward towards some of the other changes that are important is that from a salaried individual, this TCS and TDS, this credit can be set off. My co-panelist had already kind of shared some perspective around it, but let me just tell you how it is kind of happening. Now, look at a situation where an individual is having a minor child. He travels for education towards to an overseas country, say US, UK. There, he has to pay TCS if he's kind of traveling abroad. There, that TCS was also not kind of eligible against the TDS credits for the employee. Now the employee can very well declare that TCS that has been withheld in his minor child's name, and then he can claim that credit against the taxes on the salary income. Again, very welcome step. The reason for this is that the credit for TCS was earlier available only by virtue of filing the return of income, which typically meant that a person has to wait for around, say, 14 to 16 months to avail that. So again, a very welcome kind of a change. Now, and one more important aspect on the NPS that I just wanted to call out is employers will certainly need to watch out for the fact that supposedly, if the employee declares that he's opting for a new tax regime at the payroll stage, and consequently the employer has contributed 14% of basic salary towards the NPS, but finally at the return filing stage, if he switches back to the old tax regime, then that 4% deduction will be reversed. So that's how the changes are, and one has to kind of look out for that, how it will span out. Now, moving to the one example that I just wanted to call out, how the new tax regime is beneficial. So let's just take some examples. So here I've just taken an income of 7 lakh, 20 lakh, 35 lakh, and 55 lakh. So overall, what we see under the current new tax regime, at an income of 7 lakh, there is a zero tax. So for financial year 24-25, that tax will continue to be zero. And but under the old tax regime, that tax comes out to be 40,040 rupees. So this is just an example that we are talking about. Here we have just considered a small amount of deductions under the old tax regime. Now, similarly, if we look at a salary number of 20 lakh and 35 lakh, what we see is an overall sort of a tax benefit that is kind of flowing of around 18,200 to the taxpayer. Obviously, the old tax regime is not preferable because it is leading to a higher income tax payout, which is in the range of say 3 lakh 66,600 and 7 lakh 87,800 at an income level of 20 lakh and 35 lakh respectively. Similarly, for senior citizens also, we see the old tax regime is not at all beneficial, and only the concessional or the new tax regime is giving the desired tax benefits. So clear intent has been that people kind of migrate towards the new tax regime. Now, one important question, and that has been coming up in the newspapers, are that and there are lots of questions that have been asked to the CBDT director, Mr. Ravi Agarwal, as well, that whether this old tax regime will be phased out. While the government has been tight-lipped around about it, but then obviously they are saying that if majority of the people sort of migrates towards the new tax regime, then definitely they will kind of see for a kind of a phased out approach of the old tax regime. But definitely it will not be an immediate phased out that is going to happen. The old tax regime payers, generally what we see are the ones who are availing a big amount of HRA benefit, a housing loan benefit, or say ATC, ATD, they have invested a big time into that amount. So there we see that people still opt for the old tax regime. Now, in terms of an interesting statistics or a data point that I would want to share to the audience is that what is the inflection point? How to decide that whether a person should continue to remain in an old tax regime or should migrate to a new tax regime? Well, let's just assume if you have an income of 15 lakh or more and ignoring, say, standard deduction, because under the new tax regime, it is 75,000. Under the old tax regime, it is 50,000. But the inflection point is broadly 4 lakh 33,333. And it will continue up till the income level of 5 crores, because the surcharge and the cesses are basically the same under at that point in time under the old tax regime and the new tax regime. So if you are having an income sort of exemptions or deductions greater than 4 lakh 33,333, if you are having an income of say 15 lakh, more than 15 lakh, there you can continue to stay in the old tax regime. But if the investment deductions limits are lesser than that, then the new tax regime will give you the beneficial tax. Let's just move to the next slide of some rationalization of the TDS TCS provisions for the employers. What we see is that TDS TCS provisions are being rationalized, and this is basically with an intent to relax the compounding provision. I'll give you one example under Section 276B, which basically talks about say launch of prosecution if the employer has say withheld taxes on the salary, but he's not deposited that by the due date. Even a 1 day delay could have kind of attracted those prosecution provisions. So with that intent of rationalization and sort of kind of benefiting the taxpayers, this provision has been kind of come up. Now, in certain cases, what I have seen is that there was a 1 day delay instead of a seventh of the subsequent month. The taxes were kind of deposited on eighth or ninth of that month, maybe because of some payroll software change, or that person who was managing the overall salary payments was on leave, or because of some emergencies also that was there. While there were certain safe harbor provisions, but then it it still kind of had called for a launching of prosecution proceedings on the employer. So that has been kind of changed. And then what the new this budget has kind of called out, that if the taxes or the TDS deducted is paid within the due date of filing the TDS return, then the prosecution provisions will not apply. And this change is effective from 1st of October 2024. Again, a very welcome step. Now, if we look at the standard operating procedures for TDS on defaults, that will be notified in times to come. And the government and the finance minister has already said that in next further 6 months, there will be a slew of changes and slew of rationalization simplification measures that is going to happen. And in this budget, we have seen certain provisions already being kind of simplified with, say, for example, TDS provisions also, and in terms of capital gain provisions as well. Now, this budget also has kind of provided a time limit for correcting the TDS TCS statement. So earlier in there is no provision which basically kind of limits that up till when these TDS TCS statements can be corrected. Now the default timeline has been put for 6 years from the end of the financial year. Another one more important change under Section 271 capital H is that, like, for non-levy of penalty for basically not filing of TDS TCS statement, the current provisions provided for a 12-month time frame post the due date of furnishing such statement. Now that time limit has been reduced from 12 months to 1 month. Another important change that we see from an individual tax standpoint is that interest rate for delayed payment of TCS is now in line with the TDS provisions, which is 1.5%. So what we see is that if one has deducted the TDS not deposited, it used to attract 1.5%, but same provision was not there for TCS. So similar provision will now be applicable for TCS as well. Okay, so now let's basically have some deep dive onto other key announcements that the budget is making from a personal tax perspective. This is very important. The first point is very, really interesting and important, is that say what we see is that, like, people who are working in MNCs, the foreign parent, they used to kind of allot ESOPs under their stock option plan, and these shares are typically held in the overseas demat accounts. So what the finance minister had said, and it is also very evidently kind of written into the memorandum to that budget, is that sometimes these taxpayers, not with a malified intent, just forgets to report these overseas assets, and these are not very huge value, which is say up to 20 lakh. There she does not want to penalize such taxpayers under the Black Money Act, because the penalty under Black Money Act is really, really substantial, which is 10 lakh rupees. So that's how she has said that if there is a non-reporting of these small value of foreign assets, that will not attract penalty under BMA. Now, the current provision of under the BMA had already had one provision that if the aggregate balances in the foreign bank account is up to 5 lakh rupees, then also that penalty of 10 lakh will not be is not leviable. That limit has been enhanced from 5 lakh to 20 lakh. Now, this next provision is in regards to the purchase of immovable property. What we have seen is that many of the buyers they used to apply that per transaction wise, and there were multiple sort of buyers in a property. Now, the budget has clarified that look, this limit will be applicable on the total value of or total value of that property, and not just you just split that transaction wise or buyer wise. So if a property is say worth of say 80 lakhs, and there are sort of two buyers therein, so currently some of the buyers were taking that plea that I am paying 40 lakh, the other buyer is paying 40 lakh, so this TDS provision is not applicable. So this budget has clarified that it is on the purchase or the value of that immovable property, and if it exceeds 50 lakh, then this TDS provision under 194 IA will be applicable. And this change is again effective from 1st of October 24. One another important point that I just wanted to highlight is purchase of certain luxury goods will now attract a TCS. So what used to happen is obviously on say cars value exceeding say 10 lakh, this provision is already there of 1%. Now they have said that the luxury goods, if you're say purchasing very expensive bags, very expensive perfumes. Obviously, that list of luxury items shall kind of come out shortly. But as of now, the government has not prescribed it. But the government is specifying that these luxury items will also attract a TCS. This change is also very welcome. The fourth point on the reduction of the TDS rates from 5% to 2% on the rent payouts. So what we see is that people they take property on rent, and then the overall rental amount is say in excess of 50,000 per month. Then they were required to deduct 5% of the total value of the annual value of the rent and the last installment, and then this was supposed to be deposited by say 30th of April of the subsequent financial year. Now that rate has been changed, brought down from 5% to 2%, and this change is again effective 1st of October 2024. So this change has happened under section 194 IB. The fifth point is basically in regards to a tax clearance certificate. Now, the budget has specified that if you're obtaining a tax clearance certificate, it will also require clearances under the Black Money Act. So, to give a background that, say, foreign expats who come to India for work, they are basically required under the Income Tax Act to file a Form 30A and obtain a clearance under Form 30B from the income tax authorities that, well, I have paid all my taxes to the authorities, and then now I am finally leaving the country for good. So that basically, even at the immigration and airports and all, while clearances, the authorities can ask them that, hey, have you obtained a tax clearance certificate? While it is not being insistent upon, and in some cases we see that like say at some airports at Hyderabad, Bangalore, we have seen certain cases that the authorities asking the expats whether they have taken a tax clearance certificate or not. But now the government has prescribed that you have to obtain a clearance under Black Money Act as well. So this is the last point is again very consequential. They are saying that Aadhaar enrollment ID is now getting discontinued. The reason for that is now most of the people they've already have Aadhaar numbers. So they are saying that either you quote your PAN numbers or you basically quote Aadhaar numbers in your ITR. So, and yeah, and this Aadhaar enrollment ID shall be discontinued. Okay, so moving on, these are basically capital gain provisions that has been substantially rationalized, and my co-panelist has already kind of clarified how, as a measure of simplification, the capital gain structure, the government has tried to simplify it. Now, the holding period is broadly, only a two holding period, which is say up to 12 months and then up to 24 months for short term. And then for long term, it is greater than 12 months and greater than 24 months to be categorized as an asset to be a long term asset. The only exception is in case of the slump sale. My other panelist will take it up. But broadly, they have kind of kept it as a holding period only two, which is 12 and 24 months. So this is a big relief for unit holders of REITs and InvITs also, because currently it is 36 months and it has been brought at par with say other listed securities, which is 12 months or more. Similarly, the holding period for say gold or bonds debentures has been kind of reduced to 24 months from a 36-month current period. Now, what are the other changes that we see under the capital gain structure is that the section under section 111A, the tax rate has been enhanced from 15% to 20%, even if you have paid a securities transaction tax, it is levied. So clearly the government is kind of enhancing some tax over it. And eventually on the long term capital gains also, they obviously the indexation benefit has been taken away now, and the tax rate has been enhanced from say 10% to 12.5%. So there also we see a 2.5% increase in the tax rate. One benefit that the government is giving is that under 112A, the limit for exemption was 1 lakh. That has been enhanced for listed financial assets if the person is selling them from 1 lakh to 1.25 lakh. So broadly, indexation benefit has been withdrawn. What we also see is that non-resident investors on unlisted securities, now they will have to pay a higher capital gain. So earlier it was say 10%. Now they have to pay a 12.5% capital gain tax on it. But one important point that I would want to call out over here is that on unlisted securities, there is no securities transaction tax, and there is an enhancement in the securities transaction tax rates also for FNOs and all. So there is still a scope for some change. Probably that will be addressed in the subsequent budget. Okay, so now moving on, this is just a I just tried to present in a tabular form that prior to 23rd of July 24, what is the holding period and tax rates under the capital gains, and what is the tax rates post 23rd of July 24 for resident and non-resident. So what we see for listed securities, units of business, trusts, and equity oriented fund, the tax rate for resident non-resident was 10%, and it has been enhanced to 12.5%. So for unlisted shares of a closely held company, uh, 20% basically with indexation, 10% is available to a non-resident because non-resident cannot avail the benefit of indexation. So that has been now enhanced to 12.5%. Listed debentures, the tax rate applicable for resident non-resident is 10%. That has again been enhanced to 12.5%. Unlisted debentures, what we see for resident, the tax rate is 20%, and for non-resident, it is 10%. So broadly, what the budget has called out that now normal tax rate shall be applicable as the asset is now deemed to be a short-term capital asset. So there is a corresponding change under Section 50AA that they have mentioned, and these assets are now being categorized as a short-term capital asset. And there is also a change under 242A. So slump sale of an undertaking, it is 20% earlier. Now it is again 12.5%. So there we see a benefit to overall business taxpayers and all. For immovable property, again, a very a very interesting point. What we see is that, and that's how what we are seeing, a lot of hue and cries being kind of made, that they were eligible for an indexation benefit on the property. So, and the tax rate with indexation was 20%. So obviously that rate is now 12.5%, and indexation benefit has taken away. So just consider an example that Mr. A, he has purchased a property in say 2008 or 2010, and it was for say 50 lakh. Now, if he's selling that property, say 3x at 1.5 crore. So by virtue of indexation, typically the entire enhancement in that property value was taken away if we'd applied that cost inflation index. So eventually the tax that was kind of coming out in this situation was almost or closer to zero. But now there will be no indexation, so which means on 1.5 crore less, which is the sale consideration less the purchase cost, which is 50 lakh, 1 crore, you have to pay a tax of 12.5%, which is coming out to be 12 lakh 50,000. So that is the change, and that's why people have kind of raised that, look, there is an enhancement in the tax overall or outflow that is coming up. Other changes are in terms of short-term capital assets. Also, what we see is that the tax rate has been enhanced from 15% to 20%. And again, one important change is in terms of listed debentures. Earlier, the normal tax rates were applicable. Now that has been limited to 20%. Broadly, this is the overall kind of a tax structure on in terms of capital gains. Okay, now we'll just move forward, and this while this is not tax, but now there are couple of other important announcements that was made in the budget. It is in terms of ELI, which we call it. It's employment linked incentives. So previous few budgets has talked about PLI, production linked incentive schemes. So now they have shifted their focus towards ELI as well. Uh, Obviously what we were seeing in the current macroeconomic scenario, there were unemployment rates that was kind of increasing, and in order to address that, there are three schemes that the government has unveiled. Obviously the detailed fine prints are yet to be notified, but in the annexure to the budget speech, the government, the finance minister has briefly touched upon what these schemes are all about. So broadly, first scheme, what we see is it's a subsidy to the employees. The second scheme is subsidy to both the employer and the employee. And the third scheme is basically a subsidy or a reimbursement to the employers. So talking about the first scheme, the government is, and one important call out over here is that when we look at the deeper analysis of all these three schemes, these are applicable and targeted to employees who are drawing monthly salary up to 1 lakh rupees. So this is a commonality across all the schemes. And so under like let's just look at the first scheme. So first time employers, what the government is kind of saying that if you have not at all registered with the EPFO, so the government is giving them a 15,000 1 month wage, because the threshold limit under the Employees Provident Fund Act is 15,000. So that's how the government is saying that this 15,000 amount shall be given by the government to the employees, and that will be given in 3 equal installments. So one question that may arise is that, like, look, the employers have to keep these first timer or new employees with them for 12 months, and the subsidy will be need to be refunded if the employer uh, uh, sacks or fires these employees, or their employment ends within 12 months. So whether why the employer is basically being forced to give back that amount. So see, the broad contours have been kind of mentioned. As of now, the detailed provisions will be unveiled very shortly. But broadly, what we see is that it is the focus of the scheme is towards generation of more employment and all. And can the employer reduce or take back that subsidy because it is over and above, and the employer cannot just reduce whatever 1 lakh wages that they are supposed to do. But can, if the employee himself or voluntarily leaves the company, can that be reduced from the full and final settlement of the employee? That is something to be kind of seen. Now, the second scheme, what we see is targeted towards the manufacturing sector. It is applicable for 4 years, and so what the government has saying that 24% of the wages, which is split between employer and employee equally, which is 12% and 12% of 25,000, which comes out to be 3,000 per month, will rather 3,000 per year, will be given to the employer and the employee. And in the second year, that subsidy is 16%. And yeah, and in the third year, rather in the fourth year, it is 8%. And in the first 2 years, it is 24%. So that's how they have framed up the overall provision. So how the rationale, the calculation comes out to be that in the first year, 3,000 rupees will be given both to the employer and the employee. In the second year, again, that calculation comes out to be 3,000. In the third year, it is 2,000 rupees. And in the subsequent last year, it is 1,000 rupees that will be given to the employer and employee by the government of India. The broad sort of conditions around this is that, again, you have to generate additional employment, and it is specifically for those corporate entities or who are already kind of registered with the EPFO, and for the non-corporate, say LLPs and all, they should have a 3-year track record with the EPFO. So you have to increase your head count by a specific threshold which are there in the scheme. Now, Scheme C is basically in relation to reimbursement to the employers. So I'll give you an example why the rationale was kind of given, and I was even hearing the interview of the finance secretary. There, he was basically trying to clarify that why the Scheme C is also kind of brought out. The Scheme C is targeted to those employers who can sort of hire employees additionally, but then they have to choose between either to get that work done via machines, or they can get that work via labor and all. So there, that in order to kind of take that financial decisions, if that 3,000 per month for 2 years, that kind of a subsidy is being given by the government of India, then it may change to an extent that financial decision, that instead of you getting that thing done via machines, or say through capital incentive sectors and all, but you hire further employers and generate more employment. So that was the overall intent. So now employers who are catering more than 1,000 jobs, they will be eligible for reimbursement every quarter for an additional period of 2 years. And again, there is no requirement as such that the employees need to be a new entrant to an EPFO. There can be an old or already registered person as well. But the baseline hiring has been, or the threshold has been prescribed, that for an organization who is having a headcount of 50 employees, or up to 50 employees, they need to have increased their headcount by 2 employees. And for those organizations having a headcount of 50 or more employees, they need to increase their headcount by 5 employees. So that's how the schemes provisions are there. And corresponding benefits can also be clubbed. But one important point to note is that Scheme B is only for the manufacturing sector, and Scheme A and Scheme C are sector agnostic. So one can choose between which schemes that they want to kind of go with. And broadly, all schemes are for 2 years, and some of the schemes it is mentioned that will be enhanced. That is, a Scheme B shall be further enhanced for a period of 2 years. Now, moving to the scheme of internship, again, the target of the government is that people who are within the age of 21 years to 24 years, they are eligible. And from tier 3 or tier 4 cities, they can apply for internship program under this scheme. And there are list of ineligible candidates that they have specified. But the broad intent of the government is that uh, to increase the employability of these interns and the youth. Because what we see in our tier 3 cities or tier 4 cities, there is a problem of employability because of lack of skills and all. So that is why the government has unveiled this scheme. So overall, the focus is that 1 crore youth needs will be skilled for an internship program with top 500 companies. And the condition for that is that it is applicable for those employees who are not employed in their full-time education. They're not doing any courses and all. Age criteria is there. Then the stipend that the government has mentioned is that they will give a 5,000 per month of stipend, which comes out to be 60,000 rupees. And one time payout has to be given by the corporate, which is 6,000 rupees from their CSR fund. So overall training cost of 10%, say that is 10% of 60,000, which comes out to be 6,000, shall be borne by the company out of their CSR funds. Application has to basically mandatorily flow through the online portal, and companies, they can select who are the eligible candidates who can be trained via this internship program over the online portal itself. One important condition that this schemes calls out is that there is a mandatory requirement that 50% of the time for these new interns needs to be in the live environment, live sort of working environment, and it can't be just sort of a dummy environment, or they just are basically trained in a classroom training. They have to have that proper 50% of the time the work experience. Now, the overall this scheme is basically being phased in a two-way structure. So phase one and phase two. So phase one is initially for 2 years, followed by phase two, which is for 3 years. Now, list of ineligible candidates: somebody who's already doing a professional course, CAs, CMA, or if they are already basically enrolled with other professional courses, IITs and all, they are ineligible under this program. And this will be supported by the state government as applicable. So with this, I sort of end my presentation, but I'm happy to address any questions that the audience may have.
Thank you so much, Tarun. I think it was a much needed topic, especially for all of us individuals. And special thanks for covering all those detailed calculations and the employment scheme and the internship schemes. It will help a lot of young population doing it. So before we let you go, I have few couple of queries. Just a quick, since we are running very tight on time, just a quick thing. So do you think, as I asked Daksha also, so do you think in the coming next 6 months we can see old regime totally scrapped off?
So very interesting, Ridhima. So what we are seeing is that, well, they may come out with disincentivizing the old tax regime, maybe say by virtue of increased scrutiny and a slow processing of the income tax returns and all. But immediately, I don't see an immediate phase out. The reason for this is the old tax regime has been in the system for so long, and they cannot just immediately phase it out. And we are seeing the interviews, conversations with the finance minister, with the CBDT chairman also. There, they have also clarified that there is no as such plan to immediately phase out the old tax regime. But yes, as the government will continue to promote the new tax regime, which means there will be a further migration from old tax regime to new tax regime. We have already seen around two-third population has already opted for the new tax regime. So that trend will continue, Ridhima.
But do you think this will discourage people making tax saving investments ultimately? Will that have a domino effect?
It will, but Ridhima, I want to kind of clarify and bring to your attention that when the finance minister took charge and this 20 in 20 2020 21, the new tax regime was basically announced. The
Right.
moot point was that tax should not be, or tax saving should not be the criteria for your investments. So that was the clear indication that the government was making. You continue to make your tax savings. People do invest into, say, financial securities, they gain out of it. But the overall intent has been the tax saving cannot be the criteria for investments. But I
Hmm.
somehow agree that it will, like, still many salaried class individuals still think of a tax angle before making any investment decisions.
Correct. Right. Absolutely. Even they are being sold in that name itself.
Yes, yes.
See, okay, so let's see what the budget holds in the next 6 months. But thank you so much, Tarun, for your time. And I am very delighted to see all those detailed calculations you did. Thank you so much.
Thank you, and my pleasure. Thank you, Rhythm.